Good day, all participants, and welcome to the world of insurance. When you are appearing for the examination of College of Insurance or Indian Institute of Insurance, the first subject, foremost subject, it is a principle of insurance. To qualify licentiate, you have to qualify three paper. One of this compulsory paper is principle of insurance, that is IC01. This is covering various topics. IC01 is covering various topics. It is right from the management, the risk management, the concept of insurance, the business of insurance, the insurance market in India, the insurance customers in India, the insurance contract, the insurance terminology, the life assurance products, general insurance product. Maybe also it is covering the history of insurance and history of insurance in India. This is very, very important, and we will start this particular topic. In each chapter, we will be discussing about the various type of coverages, various type of concepts. Chapter 1 of the book Principles of Insurance, this is covering risk management. The risk management, it is the concept that you try to analyze the risk, you try to quantify the risk, you try to find out how much risk can be retained by you, and you try to find out how much risk and at what cost you can pass it on to insurance company. The insurance company also considers how much risk they can retain, and they are also reinsuring considering the quantum of risk and what is the retention capacity. So this risk management topic, we are going to understand the meaning of risk. We are going to understand how to distinguish between different types of risk. We are trying to understand the risk analysis and risk management techniques. And we also would like to understand the risk retention for individual, risk retention for the various commercial organizations. Basically, we will start with a classic example. Say, for example, there is a company which is manufacturing highly specialized computer parts. They are having many orders, people are waiting in queue. They are covered for everything. They are covered for fire losses, they are covered for theft, they are covered for burglary. Every type of losses what they envisage, it is covered. But then when you try to analyze the risk, you also should try to find out that, say, take this example only. In this particular company, there was a massive fire, everything is gutted down. Fortunately, their every material, everything was insured properly. Their machineries were insured properly. But when everything is lost, to reconstruct everything, to reprocure everything, because every procurement is having a gestation period. It is not that off shelf all the machineries are available when you are manufacturing a highly specialized machinery. So when such things happens, and then when there is no uh, the gestation period is there, it may take 1 year time, or it may take, say, approximately near about 1.5 year or something like this. What happens then? You start procuring, yes, you will get the, when you start reinstating, you will get your policy reimbursed, your policy will be paid, the insurance what you have taken, you will be paid for that. What about the loss of profit? Because if you are not working for now 1 year, you cannot, every worker you can say, look, you can go, you don't come. There are key workers, there are people you want to reconstruct, then you want to restart your organization. So there are a lot of expenses other than material losses. There is a loss of profit, and person should envisage how much is going to be my loss of profit. So in the risk, and then people should take cover for the loss of profit, because if they don't take loss of profit, you are not 100% insured. Maybe the material loss will be made good, but what about the process, the profit? What about the delay in startup? So all these things need proper risk assessment at the time of when you are trying to assess the risk. So risk assessment, it is a very much it is a very important aspect of your of any commercial world. You are trying to analyze the risk. So you are trying to find out there are different types of peril. What is peril? The peril, it is a basically cause of loss. So once you say the death is a final thing for a human person, the reasons for death could be various type of things, various type of perils. Once you know that what type of perils are possible, what all the hazards are possible, you can try to minimize the risk. So what are the example of perils? The fire is a peril, the flood is a peril, the earthquake is a peril, the lightning is a peril, landslide it is a peril. So event or incident that may be cause of loss, it is a called peril. So first thing and foremost thing, you should try to understand that what are the different types of peril. Because if you know the peril, if I know that there is going to be a fire, I can try to find out that how this fire can be minimized. What are the instruments I can provide in my factory organization so I can minimize the losses. There would be sprinkler, there will be firefighting organization. Then I have excellent contact with the nearby firefighting station. So these are the perils. So you try to understand what perils are operative and what care you should be taking, because then only you can go for the risk analysis and risk management. You have to manage these perils. So now we are trying to understand the different classification of the risk. The first thing and foremost thing, it is a catastrophic risk. Now, what is cat risk or catastrophic risk? This is basically a single event. It is a single event, for example, cyclones, for example, earthquake. When there was an earthquake in single event, there were a lot of losses in Gujarat. In single event, there's a flood. There were a lot of losses in Mumbai and around Mumbai. There's a single event of the floods in Bombay, and there are there's a cloud burst, and there was heavy rains and flooding. There is a single event, the cyclone Tatuke, and then the nearby shore area, there was a heavy losses. So one single event, the natural force which is leading to the losses, that is a catastrophic risk. Now this catastrophic risk, cyclones and floods, etc., this is very difficult to you can say avoid. It is you can try to minimize the losses attributable to this, but you cannot totally avoid this type of risk. So you should know that what is a catastrophic risk and what is going to be a loss, and if you are whether you are exposed to such risk. So for example, if you are staying on the hills, then definitely the tidal water is not going to flood your area, but there is a chances of landslide. So you have to try to find out that what is the risk to your house, your property, what type of perils would be operative, what type of the exposures are there around you that which will lead to the losses, maybe to the human losses, to the material losses, the financial losses, and uh, all such machineries if you have. So financial risk and non-financial risk. So what is financial risk? It is a loss from risk can be quantified in terms of monetary terms. That I know that if there is a flood and if there is a flooding, I can quantify the risk. I will have to clean the things. I will have to remove the debris. Maybe my machineries or my pumps, etc., will be in water damaged condition. But whatever the losses attributable because of the perils operative, I can quantify. In earthquake, what happened? The dwellings can fall down, the buildings can fall down, and I should know what is the cost of the reconstruction cost of the building. So I can quantify the risk in monetary terms. Non-financial risk. Non-financial risk cannot be measured in monetary terms. It is very difficult to quantify the losses because of consequential losses. This is not a monetary loss, but then this is non-financial risk. It is attributable, and it is very difficult for anyone to find out what is going to be a quantum of loss. Dynamic risk. This is resulting from the changes in economy. You see the GDP and changes with economy. There is a depression in the market. There is a no sell. Suddenly there are certain changes in the import and export policy. So these are the risk which is considered as a dynamic risk. The risk which is changing economy, which is government's involvement in the risk resulting in changes in economy. What is that? Is a dynamic. What is static risk? It is a risk loss from risk due to peril of nature, dishonesty of the other individuals. So these are the things which is known as a static risk. The pure risk, it is a the risk cannot be avoided. The risk can be quantified. There is not going to be any profit whenever the perils are operative and the damages are sustained to the to my buildings, my office, my building, my machineries, my factory, my crop, uh, uh, my vehicles, my ships, my cargo, my ports. So there will not be any profit out of this loss. There is going to be only loss. So this is the pure risk. When it comes to a speculative risk is what? Gambling is a speculative risk. The horse racing is a speculative risk. Any type of gambling, it is a speculative risk. So in speculative risk, there is a chance of winning also, and there is a chance of losing. So when the chance of it is a speculation that what will happen. So this is a speculative risk. The insurance company is not covering this speculative risk. Then there are fundamental risks. These risks affect a lot of people together because this is covering the larger area, and there are particular risks. Now this particular risk, they are affected only to specific person, the specific factory, specific machineries, and it is because of specific peril. Maybe if it is a fundamental risk, there is a flood. A lot of people will be affected by flood. If it is an earthquake, a lot of people will be affected because of earthquake. But in particular risk, if there is a fire, it is only isolated, it is limited to one particular factory. If it is a machinery breakdown, it is isolated and limited to only one particular factory. It is not a fundamental risk. So these are the things we should know about the various classifications of the risk. Now basically we must try and find out what are the hazards we are exposed to. What is hazard? Hazard is a condition that is increasing the chances of losses. It is something that accelerates the peril. So there are physical hazards and there are moral hazards. So what is physical hazard? It is referred to characteristics and qualities of the subject matter of the insured. So for example, the smoking, it is a physical hazard. The fire, it is going to be a physical hazard. The petroleum products, it is a hazardous. Edible oil or fire peril, it is possible. So you know the considering the characteristics of that particular atom or commodity, you know that whether it is hazardous, whether this particular thing is hazardous or not. So when you are trying to do risk analysis, the risk management, you should know what are the hazards, where we are exposure to different types of hazards. There could be, say for example, smoking, it is a physical hazard, and that will increase the likelihood of the fire. Loose wiring can have the short circuiting. The houses located near seashore where tidal waves can flood the area. The low-lying area, like in Bombay, there are construction in low-lying area. So when there are heavy rains, which is coupled with the high tide in the sea, the water is not getting drained out in the sea, and then the low-lying area are flooded. So this is the physical hazard. Warehouses is storing inflammable material. The warehouse is having hazardous material, inflammable, and the chances of fire is much more. Chances of explosions are much more. So, for example, individuals having a history of tuberculosis, the family history, have physical hazards, which is relating to the life insurance. So, that is the reason insurance company is also trying to find out family history of various type of hazards you are exposed to. What is a DNA thing? So this is trying to give me the idea of what is going to be a physical hazard. The next is moral hazard. This is much more dangerous than physical hazard because physical hazard can be controlled, but the moral hazard, it is a cheating. It is the person who is having a malified intention. The person is having a fraudulent intention. He wants to cheat insurance company. He wants to cheat government. He wants to cheat the seller, buyer. So there could be maritime fraud. There could be commercial fraud. So that everything is moral hazard. That refers, what is moral hazard? Which is referring to the character of a person who is approaching for the insurance. Somebody wants to take insurance with a malified intention. So you should try to understand what are the hazards, what are physical hazards, what are moral hazards, and you should also try to understand hazard. It is a condition that is increasing the chances of loss. When you try to analyze the risk management techniques, the first thing you are trying to find out what is going to be actual loss. So whenever there are losses, what are the consequences that either it will be repair, or it is a replacement, or it is a reinstatement. Replacement is the you change the atom, and then the repairing is possible whenever damages are there. It is localized. You repair it. Reinstatement is, in a way, it is like a replacement only. You are reinstating the atom which is in damaged condition. But then there are certain consequential losses. There could be, because of physical losses, there could be financial losses attached with that. There could be delay in production. There could be delay in startup. There are many consequential losses, and then the consequential losses may have, maybe I am having a contract, and in the contract, if I am giving a delayed atom, I will have certain penalty. So these are the consequential losses. So repairing, replacement, it is actual loss, physical loss, and it is expenses for maybe cleaning, the expenses of cleaning, the removal of debris. You have to clean the entire, these are the other expenses. There are loss of rent. Now these are the indirect losses. There is a loss of rent. There is a loss of production. There is a loss of revenue. There is a loss of profit. This is until the time the normalcy is not restored. Till that time, we are going to have this type of loss of profit. So these are the, you can say, the loss of profit or the consequences of loss, the damage has taken place. So there is a possible liability losses for the third party injuries. Maybe there is no direct loss, but then there are indirect losses, and which is raising the liability because of delayed, because of the not giving product in time. So such type of things also should be taken care when you are trying to do analysis of the risk. Basically, we are trying to identify what is going to be a, if at all there is a loss, what is going to be a maximum possible loss. The maximum possible loss is also known as a MPL. Now the second thing, you know what is maximum possible loss. You are also trying to find out what is the risk exposure in the maximum possible loss. That is MPL. So MPL multiplied by the risk exposure, that is the uh, uh, multiply by probability of the peril striking. So I know if my property is involved and if it is flooded, it is going to have X costing. But then what is the chances of floods? What are the chances of earthquake? So what is the probability of the peril striking that particular place? That will give me at a time what is going to be my probable maximum loss, which is also known as a PML. So any person, when he is accepting the risk, he is analyzing the risk, he is trying to find out what is my property, the cost of property, and what is the chances of peril striking, and what are chances of my loss. So what is going to be a probable maximum loss. So both these measures are necessary, and understand the risk. In risk management, what we do risk management, it tries with the, and once you know the risk, once you know the probable maximum loss, once you know the probability of peril striking, you know the maximum possible loss MPL, then we are trying to identify the maximum possible loss also has been identified. The, then there are two factors. We help identify the analyze. Analyze the risk. Once you analyze the risk and identify the risk, you see what are the where are the avenues you want to identify the risk. Human, my manpower. So what are the risks associated with the manpower which is involved in my commercial organization, or maybe my family setup? What is the risk associated for human and manpower? The next is, what is the money which I am having? What is the risk associated with the money? What are the chances of losses because of fidelity? What are the chances of losses because of frauds? Human element in that. So what is the risk associated with the money which I am handling? So for example, petrol pump. There is a lot of cash business. So you will find night time they keep it everything under close custody and only small counter is open. So because of, there are a lot of cash. And then for transportation of this cash from the petrol pump to the bank, you will find they are providing. So this we are trying to identify the chances of burglary, chances of theft when the money is involved. Similarly, there could be what are the chances of the fire, because there is a petrol, there is a diesel in fire petrol pump. So when you are trying to analyze the risk, there are people working there. There is a chances of fire and explosion. The money, the cash money is involved in that. The material involved, the petrol, diesel, etc. This thing. So we are trying to find out what is the risk associated with all these four factors. We are trying to identify the risk. We are trying to say that what are the probability of peril striking on all these things, and we are trying to find out what is going to be my maximum risk associated. Then how to prevent or avoid. So there has to be certain procedures, certain prevention method, which I should be giving, I should be providing. Say if there is a fire, there would be sprinkler. To avoid theft and pilferage, there is a direct connection with the police stations, etc. Or there is a the continuous surveillance. The CCTVs are there. It is indicated to everybody that entire petrol pump is under, not petrol pump. I'm just giving example of petrol pump. You are under surveillance. So we are trying to prevent or avoid the risk by having the techniques by which the losses can be prevented, it can be avoided, and it can be uh, we can fight with the peril particular when it is going on. How can reduce the risk? The next is you are trying to reduce the risk. So how can you reduce the risk? You have to analyze the once you analyze the risk, once you know that how this risk can be reduced, try to reduce. If possible, do not accept the risk. If you have the problem with the cash, this thing, then you say that maximum payment should be on credit cards, or maximum payment should be on. Nowadays, there are many direct systems of payments are available. So the cash transactions can be avoided. So this is the reduction of risk. Then what you consider that how much risk can be retained. You have to how much, what is your capacity of retention of the risk, and then how much risk can be transferred. Transferred to whom? Transferred to insurance company. You can transfer so much of risk to insurance company. Insurance companies also, they are considering their retention capacity and their total retention capacity. They will pass on to the reinsurers. So basically what we are trying to say, that from the current revenue, as and when loss occur, the people are either having a special fund. They will create a special fund, especially meet this type of cost, etc. in the future. Or in the second thing, what they do, they will try to pass on this risk to insurance company by payment of certain cost, payment of certain premium. So this is the way how the risk is managed basically. Basically, you should know there are various type of loss reduction techniques. What are the loss reduction techniques? See, and what are the financial losses? When it comes to financial losses, what are the problem? There is a fluctuation in stock market. That is one thing. Then there could be a fluctuation, exchange rate fluctuation, dollar rate are fluctuating. Then there are political disturbances. So what people do, they are hedging. Hedging. It's a technical term normally used. It is described to spread the risk over a period of time. It is among different avenues that are unlikely to be affected at the same time by the same way. So we are trying to hedge the risk. You see, the methods used in industrial establish is reduction of physical risk, which is early detection system. I am providing that there should not be fire. So if there is a heat, it will be detected. If there is a smoke, it will be detected. If my engines are there in my ship, and if the lubricating oil temperature is going up, it will be detected, and there would be corrective action. If I detect a fire in engine room, I will get the announcing system that we can close down the doors of engine room and smother it with carbon dioxide system. So there has to be early detection system provided. Prevention is always better than cure. So we are trying to prevent it. We are trying that early detection system. Then there are automatic responses. That means the corrective action will be taken. Nowadays it is possible because there are logic boards are there. There are computerized system are there. There are logic controls are there. So there is a automatic responses to dangerous situation through all the instrumentation. The instrumentation is such that, say for example, nowadays the new cars which have come, when the car is going on a white band, which I am continuous band, which I am not supposed to cross that band, if my car goes on that, there is an automatic correction. The car will try to steer me inside the white band. Or if it is going very close and then it is suspecting I am getting very close, I will get first thing announcing system. Maybe my car will stop automatically. So these are the corrective actions also taken. These you will find all the modern aircraft, modern ships, modern vehicles, modern warfare material, the modern industrial industries, all the early detection system, and then there is a automatic responses, the corrective systems, everything is provided. There has to be, people should be trained. I'll tell you, on my ship, in engine room, there was some problem. And then the CO2 system, that is carbon dioxide system, started immediately. And there was a hooting and there was a alarm system which was triggered. The dockyard workers, where they were listening to the alarm, but they never realized that these alarms are trying to tell me I should go away, run away from the engine room. That person remained there only. What will happen when you remove the oxygen and put carbon dioxide? The person died. So the people should be trained. People should be trained for the with the mock drills, and then they should be kept ready for taking action during such eventualities, etc. So there are different separation technique. It is isolating the subjects of exposed risk. I am not keeping all the eggs in one basket. I am trying to isolate the subject exposed to the same risk. Say for example, I have a stock. So I will keep my inventories in such a way that they are spread over a couple of places. They are separated by the blocks. They may be first floor, second floor, third floor, something like that. I will keep them away from the, say for example, flammable material or dangerous medicines or the gas cylinders. They will be kept separate. Similarly, what I used to say, that even in, for example, in Yangtze River, when the Chinese merchants used to load a boat, they will not load their entire cargo in one boat. They will spread it over multiple boats. It is only just to take care that even if one boat sinks, my entire cargo will not be damaged. So I am separating. So from there the concept of per bottom limit has come. From there the concept of per location limit has come. So the insurance company will impose you should not have one location cargo more than say 5 crores, 10 crores, whatever it is, it depends upon that particular organization. So I am trying to separate. I am trying to keep that the risk is not concentrated at one particular place. Then there is a duplication. You have to maintain duplicate copies of the documents. Even in computer system, there is a system of backup. Why I take backup? Because if my original system fails, because I have backup, I have mailed it, I have documents somewhere else available, I have kept it on clouds. So this is the way I am trying to duplicate, keeping backup copies, etc. So this is the method of what I am trying to avoid the risk. I am trying to, in case of risk, I am trying to minimize reduce the intensity of that particular risk. Then there's a diversification. What is diversification? Again, what you say, that it involves the spreading of risk across the areas. I'm not keeping, again, I said, all eggs in one basket. I'm trying to diversify them. I'm trying to keep them at different places. I maintain inventory at couple of places. So in case of one having problem at one place, okay, then I will not have the serious effect on my, I'll maintain a minimum inventory considering the reorder days, reorder level. I will not unnecessarily maintain a huge inventory that if at all there is a loss, it is going to be, it is going to have a lot of effects on me. So this is the way how I am trying to diversify. This is the spreading of the risk across different areas to minimize the risk. Basically, you try to see the retention and transfer. These two things are referred as a risk financing techniques. They seek to make good the losses. So there are two different methods of doing this thing. What we do, the risk is transfer techniques, which is including indemnity agreements. The other is hedging. What is hedging? It is a strategy to limit the risk in financial assets. So there could be hedging in money market. There could be hedging in stock market. In other words, you are trying to limit the financial losses considering by taking the actions now. The indemnity agreements. This is not transferring your, but then whenever you enter into a contract, you enter into an agreement. If at all there is a losses attributable to third party, then you are entering into agreement that one party agrees to compensate for the losses because of the other person's neglect or act or whatever it is, or maybe say the defective material workmanship. So this is the one party is agreeing to compensate other party for losses they may incur. Intermediaries like common when the risk are be attributable to the behavior of the indemnifying party. So this is the way any commercial contract in two parties, that there is a time limit. If I don't get it in time, there would be certain penalty imposed, and then the contractor's behavior is also, he has to compensate for certain losses. He has to compensate for the workmanship, the warranties which are given. It is a, in a way, it is a indemnity agreements. The risk management formally evolved as a function of business enterprise, but applies to individuals also. An individual can transfer the risk on his or her life to the insurance company by purchasing a life assurance policy. So these are the way. This is very, very important. uh, from the, say for example, if I feel that certain cars, when certain cars are defective, there is every possibility that the car owners will sue the company. They will withdraw the car. They will try to minimize the losses, because there is a warranty provided. So there are various method. The agreements are there. So I'm trying to reduce the risk. I'm trying to have the agreement by which my loss is reduced in the full process. End of day, yes, whatever remains, it is passed on to insurance company. But then this other than insurance, this is the method I'm transferring my risk, my commercial risk, my business risk to the contractor, subcontractor, and so on. Thank you very much. This is the end of chapter 1. What we have seen in this chapter 1, that is the peril. Peril, it is an event or incident that may cause a loss. Now the examples we have already given for peril, it is fire, flood, earthquake, lightning, landslide, sinking of a vessel, falling of aircraft, the car accidents, the vehicle accidents, and then the rollover of the vehicles, etc. So these are the different type of perils. What we have seen, that when you take the insurance, by taking insurance you cannot prevent the accident. The insurance is not taken by which the accident will not take place. The accident will take place, but because I have taken the insurance, my losses will be minimized. Whatever the losses are there, I will get reimbursement towards my loss from my financial losses will be reduced, of the owner or the beneficiary of the person who is taking the insurance. So what we have seen, the risk is uncertainty of outcome. If there is a chance that the outcome will be different from the expectation, then there is a risk. The risk can be classified as catastrophic risk, an important risk, financial risk, non-financial risk, dynamic risk, static risk, pure risk, speculative risk, fundamental risk, and particular risk. So hazard is a condition that increases the chance of loss. It is something that accelerates the peril. The hazards can be classified as a physical hazard and also moral hazard. The physical hazard refers to the characteristics and qualities of the subject matter, which is proposed to be insured. The moral hazard refers the character of a person who is approaching for the insurance business. The moral hazard means fraud. The intention of the person is to have the profit out of the insurance. So that is the moral hazard. The actual loss, it is arising out of the peril striking, includes the cost of repairing. You will have to replace the unit or you will have to reinstate the unit, and then the consequential losses are indirect losses until there is a loss of profit, there is a loss of business. Maybe I have to pay additional charges to my workers, the salary will have to be paid, but then there is no production. So until the repair and replacement or reinstatement, there are certain elements of consequential losses. The ways of managing the risk, what it includes, you prevent the risk. Don't keep all eggs in. It's an old adage, but then it is still there that you try to prevent the risk. You reduce the risk. You retain the risk, whatever it is possible, considering your financial capacity. And then, end of day, you transfer the risk. You transfer it to the insurance company. Insurance company will transfer it to the reinsurance company. So, loss reduction techniques, which includes separation, duplication, diversification, and then you can have the indemnity agreements with the contractors. The liability is transferred. Then you can have the aging. So these are the various techniques of loss reduction. An individual manage the risk associated to his or her life by transferring it to the life insurance company or buying a life insurance plan, or maybe I have a vessel and I know that if it is a cyclonic condition, my vessel may sink. So I'm taking an insurance. I'm transferring the risk to the insurance company for certain perils, which I feel that these are going to have a lot of losses. In every asset, in every property, in every business transaction, whatever risk I cannot retain, I'm by payment of premium, I'm transferring to insurance company.